we had done an very introductory session, and we still have some topics to continue. And this time we'll continue with that with those topics, and then we'll understand a little bit about candlestick charts and a little bit about trading view. So that is the agenda for today. So the reason for just understanding the basics of a trading view candlesticks, etc., is because that's what we'll be using for the remainder of this discussion. Throughout all the subsequent classes. So it's good for all of us to know that what it is, how it is, how to read those charts, etc. So that will help us in all the future sessions. Okay, so we'll get started. So last time we were discussing the basics of what a stock market is and so on and so forth. And today we'll discuss a few more terms. So I think in the news, whenever we go to the news, we must have heard terms such as bull market, bear market, and so on. So we'll discuss what that typically means, and we'll understand that with the help of the actual charts. So bull market is typically a period when stock prices are rising, right? During bull markets, usually investor confidence is very high. They think, yes, this is a great time to invest. Economic conditions are favorable. And that is the basic high level symptom of a bull market. So if we want to understand the bull market, we'll just have to look at the Indian Sensex or Nifty, anything that you wish to see. And then we'll remove all this. And we'll just use a simple line chart. So we see, and we'll use a longer time frame so that we can understand things over a period, over a longer period. So if we look at this chart here, so if we look at this chart over here in the of the Sensex, then we'll see typically that the Sensex has been rising most of the time. So we'll go to the weekly chart, and then we'll see here. When we see here, we see okay, over this period from 2020 onwards, mid 2020 onwards, Sensex has largely been on an upward trend. We see some correction over here where the Sensex is kind of trending a bit downwards. But by and large, the Sensex has been going up. So this is typically a bull market. Bear markets are markets when the market crashes, right? So for example, when COVID hit, the market went down very, very fast. Over a period of a month or so, it crashed very quickly. So this is typically a bear market. Another bear market is basically the 2008, 2009 recession. So for example, Sensex was at a peak over here at 20,000. And then the bear market came and then Sensex went to some 8,000 and so on. So in India, typically, as India is a growing economy, we will see longer periods of bull markets. Whenever we have some, very unfortunate events happening, unfavorable events from an economic standpoint, then we have bear market. So for example, when COVID struck, people couldn't even move out of their houses, right? So commerce, all the business that happens, everything suffers. The economy as a whole suffered. The Indian economy actually shrank during that year by a significant number. I don't remember the percentage, some 10% or something like that. It was a significant number. Similarly, in this recession, during the Lehman Brothers and during the housing crisis, so we can look at this recession during a different period, but there was a point of time when the US housing market went into a bubble. The housing prices went extremely high and then they crashed. And because of that, there was a big economic crash over here. Then the next, for example, crash that we see over here is during the dot-com bubble. So we see here the Sensex went to some almost 6,000. And then from 6,000, the Sensex came to some 2,600. So that was during the period of tech stocks. I can take one or two examples of these markets and explain to you. But overall, if you look at the BSE Sensex, it's largely been on a bull market trend. It's always been going up over time, right? So we will now go to what is mania. Stock market mania typically occurs when investor behavior is driven by irrational optimism, right? So there is irrational optimism. They think the prices will keep going higher, higher, higher. And then there is speculation. And then this speculation, and then there is something called fear of missing out. So what happens is that your, friends and other people, they start putting money in the stock market and then they start becoming very, very rich. But then we see that, hey, they are becoming rich. Even I want to become rich. Why should I lose out? And then without understanding the actual fundamentals of the stocks, we put our money in it. And because of that, we buy stocks when they are at a very high price and then the market crashes. And then the investors tend to lose money. Right. So bear markets are the opposite of bull markets when stock prices are falling. So typically stock prices are falling or they are expected to fall. And we have stock prices are typically falling. We have a lot of negative sentiment, right? A lot of panic selling, and then economic indicators are typically weak. So what does that mean? There'll be a lot of unemployment, corporate earnings. So corporate earnings, when companies are earning, their corporate earnings fall. Right. So let's look at a few examples over here to understand a couple of let's just look at COVID, for example, the COVID bear market, and let's see the corporate earnings. So we can take any stocks. Let's, for example, take the travel industry. So during COVID, what happened was that people couldn't travel anywhere. So let's look at suitcase companies, for example, VIP Industries, right? One of the prominent suitcase companies. We look at its 5-year. We'll look at 10-year just to get a longer idea. And then we see over here, this is during 2020, Feb 2020, and then it crashed. From a price of some almost 500, it went to some 200. Now, once we go into the financial statements over here, we see that during the March 2021 year, that is from April 2020 to March 2021, the net profit, the profit of the company, which from 2013, it had only been profitable. Every year we see it is profitable, but then this crashed. It went to 97 crore of losses, right? Similarly, there is, let's take another travel suitcase company, which is Safari Industries. So even for Safari Industries, we see over here, okay, this stock has gone up a lot recently. But if we see over here, during Feb 2020, it was 340, and then it crashed to some 150-ish. And if we look at the financial performance, this company, which was earning money every year, you see here, 4 lakh, 8 lakh, 4 crore, 8 crore, 10 crore, and so on. It's making profit every single year. And then we see 2021, that is from April 2020 to March 2021, the company showed a 20 crore loss overall, right? So what was happening? Typically, people were not traveling. And because people were not traveling, the company could not sell any of its suitcase and its bag and its luggage related things. But then the company has a factory that it is maintaining. It has employees for whom salaries have to be paid, but then it is not able to sell anything. So as a result of that, the company made a loss. So this is just as an example in terms of the losses that that happened. And so that is why they are saying that during a bear market, there is falling corporate earnings. Then the next thing is rising unemployment. So typically in bear markets, we'll find that there is more unemployment because companies are making losses. So for example, VIP Industries, the company was making losses, and then there were reports, etc., that some of its people were laid off, right? Because the company is losing money. It doesn't have the money to pay salaries. So what will it say? hey, I don't have the money to pay you salaries. Thanks a lot, but you can go and find yourself another job. And that way, there's a lot of unemployment also that happens during a bear market. Okay. Stock market crash. A stock market crash is a sudden dramatic drop in stock prices. So overall, the stock prices suddenly go down. Typically, there is panic selling. So let's take an example over here and we look at COVID, right? So over here, this is the COVID period. And then we see prior to COVID, the stock markets from say 2016, it was going up, up, up largely. And then over here, from a price of some 42,000, within a month and a half or 2 months, the price crashed to some 27,000, right? Almost some, how much is that? So almost some 35%. It fell down by a significant amount in just 2 months. Now, why did it fall down so much? Because COVID came, and then during April and all, we had the situation in some, especially in some of these Western countries, where there were a lot of COVID cases, and people were losing their lives. There was no proper medicine for that, and so on and so forth. Last time that this had happened was in the early 20th century during what was called the Spanish flu. And that lasted some 5 years or something like that. It lasted many years, the Spanish flu. There was wave after wave. So investors got very scared. Okay, last time there was a Spanish flu and that lasted for so long, and this is such a crash. So many people are, this is a very bad time. So many people are dying. We don't know how long this will take. It will take at least a few years to get resolved. And therefore they all panicked, and then the market suddenly crashed. And then I remember the Indian government announced the lockdown of some several days, some couple of weeks or something. And then after that, slowly the market started recovering. Okay, now the government is taking some measures to sort of contain the COVID and to make sure that the situation is functioning. Right. And then the banks and all, they did a lot of things to ensure that there is no prolonged market crash. We'll talk about some of the financial tools that banks have and all in a subsequent discussion. So we'll not go into that. But as far as we are concerned, there is panic selling, huge panic when COVID hit. And then after that, when the government started taking some measures, lockdown and certain other financial measures and all, the markets again started going up. And so we see this crash from March 2020 to somewhere around this period, right? In November, within 6 months, the Sensex was back to its previous high. So there is panic selling. Investors rush to sell their holdings because they are very, very afraid. So now if someone had a portfolio of some 1 crore and then it falls down by some 40% and they lose some 40 lakhs, obviously they'll be afraid, right? It is typically caused by major economic events like financial crisis, wars, pandemic, and so on. Okay, we'll talk about speculative bubbles soon. So we discussed the COVID market, the COVID crash. So we'll not go into global financial crisis. Right. Now, bull market is characterized by strong economic growth. So let's look at an example of a country that is growing versus a country that has not grown for a long period of time. So let's open another window and then we'll look at Sensex and we'll look at Japan. So the Japanese markets, starting since the 90s, late 90s and all, the Japanese market had a prolonged bear market, right? Let's look at Nikkei. That is the Japanese index. We'll go for a monthly chart and then we'll see. I hope it's available for a long time. We don't want all this. Okay. I hope this indicator comes up. Nikkei index. Yeah. So we see here, this is the Japanese index. And then we see from this period, right? Japanese markets had a huge boom up to the to the start of 1990 to the end of December 89. Why? because after World War II, there was Japan had suffered a lot in World War II. And then after World War II, Japanese companies were very resurgent. They started making excellent products. They were outcompeting American companies. So, for example, in the vehicles market and all the American companies, Ford, etc., were losing to the Japanese. And because of all that, the Japanese market, there was a huge speculation. You can see from here, from 74 up to 90, it just went up like anything. And even before that, it was only going up, going up, going up since World War II. But after that, it went high. And then from 1990 onwards, right until about, 2012, right, the market was in a prolonged bear market. And why was that the case? So among other things, one was the demographic trend. The Japanese were typically getting older. The average Japanese was getting quite old. They were not having too many children, and the average age in Japan was typically much higher. That's one of the key reasons. And when you don't have young working people, then who will keep up the economy, right? You need young working people who will do work and then who will produce goods, who will provide services and all, people of a working age. So and so on. So because of these crashes, because of these reasons, the Japanese economy also didn't do well. And you see over here, there's a prolonged crash. For 22 years, the market has been coming down, 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 down. And then there's been some uptrend now. So this is an example of a prolonged bear market. But if we look at India, right? India is one of the strongest, fastest growing economies in the world. And if we see India since the time the Sensex started, the Sensex has only been going up and up and up largely. We don't have a situation where even for 10 years or something, we had a bear market, right? So the markets are a reflection of the country's ability to provide goods, provide services, generate wealth, right? In India, if you see, look at the demographic trend, typically we have a lot of young population today. And this young population, as they start working, and a lot of young population is already working today, and we don't have a situation where a significant percentage of our population is full of older people, right? And our income is also generally quite low, and there is a lot of scope for improvement in terms of the average income in India. And therefore, because of all these reasons, the stock market is typically going up. So for different countries, for different reasons, it may go up, right? In Japan, we saw a case of a prolonged bear market. In India, we see a case of a prolonged bull market. So typically there is rising GDP. So gross domestic product is how much goods and services you provide in a year. In very simple terms, we'll not get technical. So as the country grows, as the country becomes richer, the value of the goods, the services and all they provide gets higher. Typically there is low unemployment and higher corporate earnings. So you take any Indian company, let's take Indian companies, any of the ones that we would like to see, any good Indian companies. Let's look at Reliance. That's the first industry one that comes to our mind, right? Typically, when we think of when we think of India, you see net profit was at some 20,000 crore for Reliance Industry. This is going up, 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 and then it is at almost 80,000 crore today. If we are able to see from March 2000, we will see that the trend has been continuing since March or since March late 90s. The income of this of Reliance Industries has only been going up and up and up. Let's look at, say, some Tata company, for example, right? We can take, I don't want to take a cyclical company. So let's take, for example, Trent. That's a Tata company. It has Zudio and all those products for clothing and all of that. So if we look at Trent also typically, okay, Trent has some, let's look at only operating profit. We'll not look at the net profit. So you see operating profit typically every year it's going higher, 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 right? So whichever Indian corporate you take, let's take, for example, a paint company, which we would all have heard of, right? Asian Paints. Again, you see typically year on year, on average, year on year, it's been going significantly high. This was some 1,160 crore and today it is some 5,000 crore. Let's take another company which we would have all heard of, which is the company which produces Fevicol, Pidilite Industries, right? You see here again, the profit is going higher, 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 and so on for the last 10 years. And if we had this chart for the last 20 years, 30 years, we'll see that that has been the trend continuously. So since the Indian economy is growing, there is higher corporate earnings, and this is expected to sustain for the next couple of decades at least. Okay. So bear markets we've generally discussed. In Japan, for example, there is falling GDP. The falling GDP in Japan's case was caused by the aging population, right? And then there high unemployment happens in some bear markets. So, for example, in the 2008 recession or even during COVID, there was some unemployment that happened, right? And then we'll not go into interest rate and inflation and all now. So then I think one more thing that we need to discuss, I had it, it's not there in the notes, but we'll talk about what is a stock market mania, right? And we'll take two examples of stock market manias. The first example is the one where a lot of us have been witness to it, which is during the 2000 dot-com bubble. And then the second one that we will discuss is the South Seas bubble, which is a slightly older example. So let's take the 2000 stock market. Maybe we could look at some American index, but anyway, we've been looking at Indian. So let's look at the Indian index. So typically during this period, during the late 1990s and the mid 1990s, we had the advent of the internet. In the 80s and all, there was no internet. People used to talk via normal mails, writing letters to each other, and so on and so forth. They would buy a lot of newspapers and so on. But today we get everything in the internet. So during the 1990s, there was a lot of the internet started becoming quite common, and there were a lot of companies that were founded on the basis of the internet. So one of the famous companies that was founded during this period was, for example, Amazon. Right? They said, okay, Walmart is this big company that is selling that has these large stores that is selling everything offline. Then Amazon said, we'll do it online. They started with books, and then slowly they expanded their categories. So during this period, there were a lot of companies that started purely on the basis of the internet. They said, okay, we are an internet company. We are going to revolutionize this. We are going to revolutionize that. Now, companies like Amazon had a good business model. They had an idea saying, okay, this is how we will grow. This is how we will earn money. This is how we will have a long-term business future. But there were many other companies which just started. They just started some .com website, and then, but they didn't have any business model. They didn't have any way to make a proper profit, because in business you need to keep making profit, right? But still, because it was all this, there was this internet mania saying that, okay, internet is going to revolutionize the world. People blindly started buying the internet companies irrespective of whether the company had a loss, the company had a profit, they didn't care. They just said, okay, this is an internet company, this is going to go up. The internet is going to revolutionize the world, let's buy it. And then what happens is you see someone else buying and someone else is making money. And because of that, you also want to buy. You don't want to miss out. And then it keeps going higher, 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 higher. But at some point, it becomes clear that, hey, these companies are not making any money. There is no proper business model for them, right? And then some people start selling. And when some people start selling, the other people, everyone else starts panicking, and then everyone starts selling, selling, selling. And then it goes down, 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 right? So why this up and why this down? It is because of a few human emotions we have previously discussed. And the most important of that is greed. Everyone wants to become rich. Everyone wants to make a quick buck. And the other one is fear. They say everyone else is making money and they don't want to miss out. And because of that, we can see that the stock markets go up and up and up, right? So another example, it goes up and up and up, and then it crashes, crashes, crashes. And then you see over here, Sensex was at some 2,800 in 1998. And then here it came to 2,600 in 2001. So finally, it ended in a situation where in 2001, Sensex was lower than this point. And why? That's because of the greed. So if you see Infosys and all, the Infosys share price and all shot up like anything. And then it came down, even though Infosys was a company that was doing well. But there were a lot of tier two companies whose prices shot up and then they crashed and then the companies also crashed. Right. Some famous companies that survived this was Infosys and all. They had a very good business model. But there were a lot of other tier two, not so good companies that rode this wave and then that came down. So let's look at another stock market bubble, and that was during the 18th century, right? So all of you would have heard of Isaac Newton. So Isaac Newton had uh, lost money in this stock market bubble called the South Sea bubble, right? The financial South Sea. So what happened during this period? Let's understand that. Uh, During the 1710s, 1720s and all, the continent of the Americas had been discovered and then people were going into the Americas. The Europeans were going into Americas and primarily they were trying to make a lot of money in the Americas. Human greed, the desire to make more money was obviously one of the biggest motivators for as long as maybe humans have existed or since the start of the human civilization. So they, so there was this company that British government, the British opened, and it was called the South Sea Company. And the South Sea Company, they had exclusive trading rights with South America for any South American related trade that Britain had, right? And that company was opened, and then during that period of time, a lot of the trade was, slavery. They would import slaves from Africa and so on, and then they would move them to South America. And the South Sea Company was also involved in a lot of that sort of trade. Now, the problem was that South America was largely owned, or the South America largely belonged to Spain and Portugal, not to the British. And the British had a war with Spain and so on, and so they were not on very good terms. So this South China Sea, the South Sea bubble, the British, they started this company. A lot of investors started getting in. They started getting in thinking that, okay, there is this trade with South America. We are going to make a lot of money. This company is going to become very rich and so on and so forth. And then they basically, the price of that stock went up. And after it went up, at some point, the company was not making any profit. People realized that, hey, this company is not making any profit. And then people tried to exit the stock market. Yeah. So I think this is the chart that I had in mind. So let's look at this chart. So this is the South Sea Company. And this, you can see, this was during the year 1720. From Jan to December, this shows the basic mm, price movement, and we see it is very similar. So if we go to the 2001 recession and we compare the stock market over here, we see over here also, you see this, it goes up and then it crashes, right? It goes up and then it comes down. This was in 2000 in Indian stock market. Now this is in the year 1720 in Britain. And again over here you see it goes up and then it crashes. So Sir Isaac Newton, one of the great scientists, being a privileged great scientist, he was able to buy the stock at a very low price. Right? He bought the stock at a very low price, and then he understood that no, this company may not make money. So he sold this stock at a very good profit. So he'd already made a significant profit over here. But then what happens? Newton sells it, and then this company starts going up and up and up and up and up. Right. And Newton sees that all the other people involved with the company, they are making money and he is missing out. So this great scientist who had, brought about so many theories, mechanics, gravity, and so on and so forth, this great scientist then starts buying at a higher price, right? He starts buying at much higher prices. And after he buys it, the stock collapses. So he had made some amount of money here, but he lost a lot more money here. And that's when Newton uttered a famous phrase. He said that he could, which the summary, I don't have the exact phrase here, but what he said was that he could predict all the heavenly objects, and he could predict motion, and he could predict all those things, those complex scientific things. But he is not able to predict the madness of men. That is what he said. I cannot predict the madness of men. So essentially what happens in these bubbles is, so even in the 2000s, just as Sir Isaac Newton, he bought a stock here, he sold it here, and then he got caught, and then he bought stocks here, and then he lost money, right? During this 2000 bubble, we had these good fund managers, especially in the US and all. And then these good fund managers, they understood that no, this stock market mania doesn't make any sense, right? These companies that are going up, they don't have a good business model. And I forget the names of these fund managers. I had read it in some books earlier. So these fund managers, a couple of fund managers stopped buying tech stocks, right? They said, no, this is going to be a crash, and we are not going to buy this. What happened? The customers who had put money in these funds, they started saying, hey, fund manager, you are useless. I this other fund is making so much money, that third fund is making so much money, that fourth fund is making so much money, but you are not capitalizing on such a good trend. These tech stocks are wonderful. That's what the customers started saying. These tech stocks are making wonderful returns and you're not getting into it. So these fund managers who never got into it, were forced to get into it somewhere here, right? Somewhere at a higher point. Because their clients started withdrawing money. They started withdrawing money and then they started putting it in other funds which were investing in tech stocks. And so these fund managers started putting money at a higher price. And then you know what happened, right? The market crashed and then their funds went into a loss. So the lesson that we have to learn is that, listen, we can all be very rational, right? Sir Isaac Newton was a great scientist, very, very rational individual. And yet, under the pressure of of what the crowd is doing, under the pressure of, greed and fear, and under the pressure of wanting to make more money, not wanting to miss out, even such a great scientist made a mistake and he lost money, right? Similarly, great fund managers who have made lots of money throughout history, and all of those people who understood that no, this is a crash. This is not a sustainable upside. Even those people ended up losing money because of the pressure from their client and because of the performance that their fund has to do well and so on. So basically, under this greed, under this fear, even people who are very, very rational, people who are very, very logical, people who understand things very well, they tend to get carried away by these emotions. They tend to get carried away by the opportunity to make more money, by the fear of missing out and so on. And they tend to make mistakes and they tend to lose a lot of money. Right. So this is something we will come back to again as we invest, because this is something we need to be very, very aware of as we are investing in the stock market, right? A lot of times investments are driven by purely by human emotions, greed, fear, and so on. So if you see Warren Buffett, a famous investor, he had this line saying, be fearful when others are greedy. Be greedy when others are fearful. Let's just understand this. So it's wise for investors. Warren Buffett once said that it's wise for investors to be fearful when others are greedy and to be greedy only when others are fearful. So what does this mean? When are others fearful? Others are fearful during this period. From here, when it comes here, everyone is very, very fearful here. This is the time to be greedy. This is the time to buy, right? When is everyone greedy? Everyone is greedy when the stock market has gone up nicely. They say, oh, others have made so much money, I have to make money. Everyone is investing during this high period. That is the time when the good investor should be fearful and a good investor should exit. Right. And we will come back to this in future when we talk about specific investing strategies and approaches. Okay. So any questions or any doubts so far? We can have a few minutes to answer questions and then we'll proceed. Okay, so I think if we have no questions, then we will proceed with the next part of the discussion. Right. So from now on, whenever we start using when we start discussing stocks throughout this discussion, we will be using this trading view. And in this trading view, if you see, there is this is the typical line chart. So if you see Google, let's go and say Sensex in Google, and then you see this line chart, right? This line chart typically only gives us the closing price of each day. That's what happens. So for example, on this day, Tuesday, April 11, the closing price was some 5,537 or something. On this day, uh, 12th July, the closing price was some 4,968 and so on. This only gives us the closing price. But for us as investors, right, we need to understand not just what the companies are doing, not just the profit loss of companies, but we need to understand the sentiments of what the other investors are have, right? We need to understand the behavior of other investors. Otherwise, what will happen? We will make such decisions. Now, if we had understood the behavior of other investors, when are investors feeling optimistic? When are investors feeling pessimistic? We could have made a good entry. So, for example, right, let's say that we had a system to see when is the investor, optimistic, or when is that optimism rising? We enter that stock. And then when is that pessimism starting and when is that pessimism becoming very high? We exit that stock, right? So in order to understand the behavior of other investors, we will need something called called technical analysis, right? And in that regard, from today, we will start reading about trading. We'll be reading about this one, the candlestick patterns. Right. So let's just take the same, let's just take Sensex in both the charts, right? And then in one, we will look at it with a line pattern, and in the other, we will look at it with a candlestick pattern, and then we will understand what are candlesticks. Okay. So we'll just take the daily chart. And then over here, we will take the line chart. And just quickly go to the end. Okay. So we see this. It's the same BSE Sensex, and we see this, right? Let's just zoom in a little. So I think here now we see the same set of dates, and then we can see a somewhat similar shape. So what is this candlestick and what is this line? The line chart will give you the closing price. The line chart will give you the closing price of any particular day. We'll just take day, for example, right now for the purposes of discussion. Whereas the candlestick will give you a lot more information, right? And we will now try and understand what is this information. So candlestick charts have multiple things. One is they will tell you what is the opening price. So stock markets open at say 9:15 a.m. and there will be a price at which they will open. Throughout the day, they will be trading, right? People will buy, people will sell, and so on. So during the course of the day, the stock will hit some low price. Okay. And this is the low point. Then at some point, there is more buying, 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 buying. The stock price goes high. And then at some point, the stock will hit a high point. Right. So this is represented by the straight line, the high point. And then the stock may come down, come down, come down, and then it will close. So this is the closing price. So the line chart will only show us this particular point, right? The line chart will show us only this particular point. But the candlestick chart will show us the behavior of investors throughout the day. Okay. So it will tell us what was what was the price at which the stock opened. What was the low price that the stock went in during that day? What is the high price it went in during that day? And then what is the close price? Now we see there are two colors. One color is green and one color is red, right? So green means the closing price is higher than the opening price. So that means green means it's a good day. It's a bullish day. The markets are going up. So it is indicated with green color. Now, if you look at red, right? In red, this is the opening price. Okay, this is the opening price. Then during the course of the day, investors buy, it goes to this price. But then there is a lot of selling. It comes down. People sell, 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 sell. So the price goes down. This is the low point. And then at some point of time, there is some more buying. And then this is the price at which it closes. So both these charts are very similar. The main difference is that this is the open price. Whereas in the reddish candle, this is the open price, right? So now let's look at the Sensex again. So now what is the information we are getting here? We are able to understand, okay, on which day, what exactly happened, right? So let's take this chart, for example, this particular candlestick. So in this candlestick, we can see, okay, the stock market opened at around 81,778. But then it kind of went down, 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 down. We don't know. It may have gone up first. It may have gone down first. We don't know that. But during the course of the day, at some point, it went down, 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 down. So why does it go down? Because there are a lot of sellers. So there are a lot of sellers who are selling the stock and then it goes down, down, down. But once it touches the low, then the buyers are coming in. The buyers are buying, 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 buying. It goes up. And then again, the sellers are selling and then it goes down, 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 down. And then somewhere here, very near its starting point, this stock basically, this has closed during the day. So what does it tell us about the market sentiment? It tells us that the market sentiment is neither bullish nor bearish on this particular day, but it was basically even, right? It was basically evenly spread between the buyers and sellers. But let's take another candlestick chart. For example, let's take this one, right? Again, this is the Sensex. We are looking at actual data of the last few days, September 4. So on September 4, we see the Sensex opened at 81,800, right? And then it started going higher, 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 higher. It went up to some 82,422. And then it started going lower, lower, lower. And then it closed at 82,352. So what do we see? We see that from the opening price, the Sensex never really went down, right? We only see that it goes up. And then there is a little bit of the body of the candlestick is over here, but there is a little bit of a wick here. So we saw that it slightly comes down. So then we know that on this day, the Sensex has a very bullish sort of a trend. It is a very positive trend. Similarly, if we look at this stock here, this day here, right? Sensex starts over here. Maybe it goes a little higher. This wick ends here. But then what happened? It goes down, 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 down. Throughout the day, it's crashing. It goes to some lower point here, and then it kind of comes a little higher, and then it closes here. So looking at this line chart, I don't know. Was this day bullish? Was this day bearish? What is the investor sentiment? I don't know that. Right, each individual day, I really don't know what is happening. Whereas here, each individual day, I know what is the kind of behavior that different investors have. So that is the candlestick chart. So now if we look at candlestick charts, we are also able to kind of predict when the market may become bearish and when the market may become bullish. So maybe we'll just take an example here. And see, I don't use the candlestick exclusively, but I just know how to read it so that I get a picture of what is going on, right? So then you will find a lot of names. You will find doji, reverse doji, all sorts of names, hammer, inverted hammer, all sorts of names. I have never bothered to learn these names, but I have just bothered to understand the logic, right? So let's look at this particular candlestick in isolation. So what happens on this day? The stock opens at this particular point. And then there is a lot of selling pressure. The stock goes down. But then what happens? There is more buying pressure, and then the stock goes up. And then the stock closes here in green. Right. Now, if we look at this diagram, we see that, okay, previous few days, market crashed, market crashed, market crashed, market crashed. Here, there is a little bit of an upside. Then again market crashed, again market crashed. Now again here we are seeing there is again a little more of upside. Then we'll wait for one more day. What is happening the next day? The next day the market opens at a particular price. It's going up, 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 up. And almost throughout the day, there's a slight wick above, but almost throughout the day, it has only gone up. So then we can say that, hey, it looks like the market is changing its trend. We can never be 100% sure. Candlesticks are never 100% fail safe, but it is just a picture. It is just giving us an idea saying, hey, looks like maybe the market is going on an uptrend, right? Similarly, let's look at this particular chart. The market is coming down, it's coming down, it's coming down, it's coming down, right? And then we see a little bit of bullishness here, but then again it's coming down, again it's coming down. And then let's notice this wick here. Here we see there is a small red candle, right? So market opened at this point and then market closed at this point. The next day, the market again opened at this point, right? But the market went much higher. You see, this candle is actually much bigger than this candle. So the market went much higher. Then again, the next day, the market is going higher. So then we can say, hey, maybe the market is on an upward trend, right? Similarly, let's look at this particular chart. The market is going down, going down, going down, going down, little bit of bullishness, going down, going down. And then here we see a different sort of candle. We see market is opening here actually, going down slightly. Then it is going a lot of buyers, a lot of buying pressure going higher, higher, higher because everyone wants to buy the stock. But then again, the sellers come in and then people are selling, 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 and then it ends up here. But you see, there is net positive buying pressure overall. Then next day, by this time, all the sellers have sold. During this day, a lot of sellers sold. During this day, a lot of sellers sold. During this day, a lot of sellers sold. So many sellers have sold. And now the buyers are coming in. A lot more buyers now, right? So people are again buying and willing to buy. And because there are more buyers, a lot of buying pressure, stock prices again going up, 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 up. And then the price is closing here. So then we can say, yes, the market was going down, but now the market seems to have changed the trend. Okay, so we've seen a few samples here. Now let's look at the actual Sensex. Great. So let's look at the charts here. It's not a very strong bullish or a bearish trend, but we get a picture. See over here, the Sensex was here bullish. It's then slightly bearish, but you see, even though these are red candles, you can see this candle is opening here, but this candle is opening much higher. So still there is some bullish sentiment. Then this candle is opening much higher and then it actually came down. But again, the next day, this candle is opening higher, then it came down. But then again, it is bullish, right? Then it is bullish and we see this and so on. So generally a little more bullish sentiment than bearishness. And then we see this candle. This candle over here, this candle opened over here. And then we see it's a huge, say negatives, huge selling pressure. The candle comes down, down. It actually comes down up to this point. But then there is some buying pressure and then it comes up a little bit, right? So then we can say, okay, there is a small bullish candle here, but there is a large bearish candle here. And also here, there are little bearish sentiments. Maybe the market will go down. At this point, we might be able to take the decision. Next day, we again see a bearish candle, right? So this is again confirmation that, hey, the market trend is changing. Now let's look at this. The market has come down and then again over here, we see a slight bullish candle. Again, the next day, slight bullish candle, right? The market actually, it opened here, selling pressure, it went till here, but then there is buying pressure, it went till here, and then it kind of came down and settled here. Then again, here we see another bullish day. So at this point, we can say, okay, this trend that came down, now that trend seems to be reversing, right? And because that trend seems to be reversing, now this seems to be a good buying point. So now let's go to the COVID period and let's see how we could have taken that, how we could have viewed and understood the COVID period using the candlesticks. Okay, we'll go back to the daily chart. Okay, so this was the COVID period. Okay, The markets were over here, 42,000, 41,000. We see the markets over here. This was probably a high point, 42,000. From here, we see there is slightly more bearish trend. We see small bullish lines, but immediately it again is going bearish. We see a few more bullish lines, but then again it's immediately going bearish. And then here the crash starts. From here, if you see almost every single day, the stock market is going down, going down, going down. We see one positive candle here, right? But again, the stock market is going down. And then here we see two positive days here. Then again, the stock market goes down. But then the next day we see it is not so bearish, right? Here it's a very bearish day. It opens here and then it goes all the way here. It closes somewhere here. But next day it opens very high. Even though the price goes down the next day, the price comes up and it closes here. And then next day we can see the market is again going up. The market is going up and then here it is again going up. Then we see a few more bearish candle. But what do we see? This bearish candle we see it has a much lower price, closing price. So if we see this one, and we'll talk about these trends and other things later. But you see this is the closing price of this bearish candle. But what is the closing price of this bearish candle? You see, this is much higher. You see, this bearish candle is much higher compared to this one. And then it starts going up again. So then we can see, okay, maybe the trend is changing, right? Maybe the trend is changing. That is the information that is coming from here. But what happened during this period? During this period, the Indian government had announced a shutdown, right? They announced the shutdown and then all the stocks which were at a higher price, they all came to a very low price. So using the information that, okay, government has announced a shutdown, government is doing several measures to tackle COVID, right? And then stock prices and all have come down nicely. And then maybe the candlestick trend is also changing. Using all this information, we can take a decision saying, hey, maybe I can purchase the stock right now. Or, maybe I can purchase the Sensex right now. From here, it looks like it might go high, right? And then what happens? Let's say we put a small purchase here, but still we are not very confident. We don't know for sure. And then next day, you see there is a lot of selling pressure here, but still it's a bullish market, a bullish candle, right? It opens here, goes up, a lot of selling pressure, closes here. Next day, it's again bullish. Then 2 days, it is bearish. It's coming down. But again, this opening price is over here, right? Let's zoom in a little. This opening price is over here, but then this opening price is actually higher the next day. So, okay, even though it is bearish, we see it is not, see, like this bearish, this opening price is here, this opening price is lower. It's going down, but this is, okay, we see it is somewhat bearish, but we are not sure yet. Then we again see a bullish market, right? We again see a bullish market. And then here again, we don't know. There's a lot of buying, there's a lot of selling. This again, buying price is very high. The opening price is very high, sorry. The opening price is over here and then it's slightly coming down and then it's closing here. This closing price is higher than this closing price. So, okay, even though these are, red candlestick, but when we compare the prices, we are seeing that, okay, maybe this looks a little, not fully bearish. Right. But this day again, it crashes. Market opens here and then closes here. This day is bearish. But next day, it's again bullish. Next day, it's again bullish. So we see here. Now, where is where are these lines now? Let's see. So we see one is over here, right? This is the next bottom formed by the market. And then here, this is the next bottom formed by the market. So overall, what can we see? The market closed here at a low point. Then the next low point is over here. Then the next low point, the market came down. Next low point is over here. Market went up. Market is again going down. Next low point is over here. So from this point, we can become more confident that now there is a bullish trend ongoing. Right, there seems to be strong support for a bullish trend. So again, at something like 30, 31,000, we can again maybe invest. And then what happens? Then we see again the market kind of going up, then again kind of going down a little, and then it continues to go up. So until this point, there is still a little bit of selling pressure. There is still a little bit of fear and all of that. but after that, the market becomes very positive, right? So this is the way we can use candlestick chart. We should never use the candlestick chart or these trend lines and all just on its own. We should always use it with the help of financial fundamental analysis. What is company performance? What is government doing? What are the indicators? We should understand all that, and then we understand the sentiment, and then we should take a decision in terms of whether to buy something or to sell something. But this is how a candlestick can help us. It will just give us a little more information about what is happening in the markets. Okay. So any questions over here? Any doubts? Any questions?
Hi, Harish, this is Bajit.
Yeah.
Uh, I'm sorry if you already answered this question. My question is, are your sessions going to be predominantly fundamental driven or technical driven as well, or
It's
both
going to be a
fundamental?
mix of both. So I have
Okay.
given one. I have given one in the WhatsApp group. I have given one topics, set of topics, right? So we'll first do fundamental analysis, then we'll go to technical analysis. But even while doing fundamental analysis, I will be looking at candlestick charts and so on. So that is why I thought we'll start candlestick today, just give an introduction. But after this, it'll all be a lot of fundamental analysis, and then there'll be a lot of technical analysis.
Okay, you use technical analysis for buying and selling decisions, right? And
I use
otherwise, your
fundamental.
thesis.
I use fundamental analysis for my buying and selling, but then I will use technical analysis to decide what is a good price
For buying.
for both buying and selling, to decide what is a good price to buy or to sell.
Okay, okay, fair enough.
So
That's
let
clear.
me give you one example, right? There is the stock called Safari Industries. We discussed it earlier today. So let's look at Safari Industries share price during this period. Okay, the stock is not coming. Okay, let's look at screener. No problem. Let's look at Safari Industries share price, and we will go. We have to look at, we are not able to stretch it beyond the point. Okay. You see Safari Industries here, it was at 450 approximately, right?
Yeah.
And from here, Safari Industries, let's not look at COVID. Let's look at the period before COVID. From August 2018 till November 2019, it went from some 450 to around 280 something. It was falling for this 1 year period.
Yeah.
But what do the financials indicate? Let's look at the financials during this. So 2018 was 419 sales, right? 2019 sales is going up. 2020 sales has again gone up. Profit 2018 is 22 crore. 2019 is 27 crore. 2020 is 31 crore. So even though the company financials are very good, right? The stock price is going down. The company is growing. It is getting more sales, more profit, but still the stock price is going down. Right. And why is the stock price going down? It's because of a lot of factors, mainly investor sentiment, due to which there was a mid cap, small cap crash during this period. Right.
Hmm.
So over here, if I only rely on fundamental analysis, I will continue to hold the stock. I will say no, fundamental analysis is good. I will continue to hold the stock. But if I use it in lieu with technical analysis, I look at this and I say, hey, valuation of stock has gone very high and now it's kind of going down. I will not be able to get out at this peak, but somewhere here I may get out.
Yeah.
At maybe 370, 380, I may get out. And then I will go to some other stock. Right. So I will
Yeah.
use both together, and that's how I do my investing.
Oh, perfect. Okay. Thank you.
Okay. Yeah, sure. Okay, so I think let's take an extra 5 minutes. There are a couple of other things that I had wanted to show you. This is something we should all see. Okay, so let's go to Sensex. We will take a candlestick chart. My request is that we should all make you know, we should all have a free account, and then we should just try out these things. See, now today we have some indicators in this which we should understand. Okay, let me look at, let me show some. Yeah, see this. From this point, how much gains have we had? Right, we want to see that. We come here we go up, and then we see this. Okay. Where is the, it's okay. 1 second. Let me, maybe I used the wrong one. Date and price range. This is what we have to use. So from this point till this point, or let's take till this point for discussion purpose. Let's say we want to see how much is the increase from this point to this point, right? So we can see that over a period of 212 days, 140 bars, because weekend, holiday, everything is not included. So over 140 trading days, the Sensex from this date to this date went up by 19.77%, right? So for example, let's take some other companies. Let's take, for example, CDSL. Okay. So now I want to see from its bottom point, how much has the stock gone up? I will take this date and price range. I will put it here. I will just drag it, and then I will put it until today's close. That is until this point. Okay. We'll see here that CDSL over 362 bars, 535 days, but 362 trading days, it has gone up of over 200%, 207.56%. Right. Now, let's say I want to see a bear market scenario, right? Okay, CDSL went up so much, but how much did it go down? So we come here, we again select this. Let's say from this point, we want to see the bottom. We start from here, we come right to the bottom. And then you can see here from the previous peak. From this particular peak, CDSL has gone down by 47.44% over a period of 468 days. Now, why is this information important? Now, let's say CDSL has gone up now. Let's say CDSL has gone up. Let's say that over the next, say 1 year, CDSL goes down, 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 down. I want to decide what is a good buying level for CDSL, right? At what point can I buy? How much will the stock go down? So usually I can see, okay, last time stock went down by 47%. Before that, stock went down by say some the 50%. Like that, I can just see that, and I will get an idea. I will get an idea saying, okay, over the last say 3 or 4 times when the stock went down between 45 to 60%, right? So when it is around 50% down, I can start my buying. And then you can make such, so this sort of a calculation will help you in those sort of decisions as well. Right. Now let's look at another indicator, CAGR. Okay, CAGR custom range. Why is this not opening? Okay. You see this from this point to this point, CDSL stock has given average of 41.7%. We can see that. Right. If we want to choose another, let me delete this. And let's again go to the CAGR custom range. Okay. Now we will start from this high point. From this high point till this low point. We want to see till this low point. Okay. CDSL gave minus 56.4% per year. So like this, we using this technical analysis, using this trading view, we have these metrics that will help us better understand. Right. Next thing, we used one of the horizontal lines. Okay. So we'll see what is the bottom. So we can use the horizontal lines that we were using. Okay, we can see this is the bottom. Okay, this is one bottom that CDSL made. This is the second bottom that CDSL has made. I'll use one more horizontal line. This is the second bottom that CDSL has made. Right. This is the third bottom that CDSL has made. Now, what is special about this bottom? You see, this peak price of CDSL, this top, this high price of CDSL is very similar to this bottom price here. Right. And we will talk about support and resistances in a subsequent session, but please just remember this. Not 100% applicable, but a lot of times you will see these sort of trends happening. So I think we are a little over time, but when you get time, my request is let's please go in here, right? Create a free account, and then we can just try some of these tools, at least the ones that I have shown, how to draw horizontal lines. Then we can draw a trend line like this. We can say, okay, CDSL is coming from here to here, right? And then we can predict, okay, maybe next time if it comes down, it may come somewhere around here and then it will go up. Maybe we can't be sure of these things, but these are just points that help us in terms of making our analysis. Now, I never take a decision based on just these lines and all. My decisions are always based on fundamental analysis, but I use some of this data to help in better buying and better selling points. Okay. So I think with that, we come to the end of today's session. So any doubts?